VOO and IVV are both described as simple ways to own the S&P 500. And at the level of index exposure, that description is correct. Once you move past index level exposure, ETFs that track the same index are not interchangeable. Differences in structure, incentives, and mechanics quietly compound into different outcomes. VOO and IVV both track the exact same benchmark, the S&P 500 index. That means the exposure is identical. They have the same technology concentration, the same earnings cycles, and the same sensitivity to inflation, interest rates, and recessions. There's no decision making edge inside either fund. If someone claims one fund chooses better companies, they're confusing ETFs with mutual funds and misunderstanding how index investing actually works. From a pure market exposure standpoint, VOO and IVV are functionally identical. The differences arise from structure and implementation. VOO is issued by Vanguard. IVV is issued by BlackRock. Issuer incentives shape how ETFs are built, maintained, and used, especially over long horizons. Vanguard's structure is client owned. There's no outside shareholders, no quarterly earning pressure. When Vanguard lowers costs, the beneficiaries are the fund holders themselves. Persistent fee compression, tight tracking with minimal friction, operational decisions optimized for decades, not quarters. VOO is structured for long term ownership. BlackRock operates under a different mandate. It's the largest asset manager in the world. It operates across pensions, sovereign wealth funds, banks, insurers, hedge funds, and governments. Its priorities are scale, liquidity dominance, and integration. IVV is built to interact seamlessly with institutional balance sheets and derivative markets. It's deeply embedded in prime brokerage systems, ETF arbitrage desks, and macro and derivative substitution trades. BlackRock's ETFs are designed to be flexible instruments. Vanguard's ETFs are designed primarily for long term ownership. Both funds track the same index, but they're designed for different use cases. On paper, this looks simple. VOO's expense ratio, 0.03%, and IVV's expense ratio, 0.03%. Same fee, but that conclusion is incomplete. Expense ratios measure only explicit published fees. They don't measure the full cost of owning an ETF. Expense ratios don't capture cash drag from uninvested balances, dividend reinvestment timing, and index reconstitution efficiency. Two ETFs can charge the same fee and still deliver meaningful different net outcomes. ETF outcomes are not determined solely by published fee schedules. Outcomes are affected by execution timing, liquidity conditions, and operational constraints. VOO's structure is designed to minimize implementation inefficiencies. Idle cash is reduced aggressively, dividend reinvestment is prioritized, operational decisions favor long term holders over trading flexibility. IVV's structure allows slightly more flexibility, not because it's inefficient, but because it must accommodate constant institutional interaction. That flexibility supports liquidity. Liquidity supports trading. Trading introduces incremental execution costs. Both VOO and IVV participate in securities lending. When a hedge fund wants to short large cap stocks, it needs to borrow shares, and ETFs are one of the prime sources. That borrowing generates revenue, priced dynamically based on demand, volatility, and share scarcity. Vanguard returns nearly all securities lending's revenue back to the fund. That revenue flows directly to VOO shareholders. BlackRock retains a large portion of that revenue as compensation for running the lending program. Tracking error is one of the most misunderstood concepts in ETF investing. Institutions treat it as a diagnostic tool. Tracking error is the difference between what the index theoretically delivers and what you actually receive as an investor. Over short periods, the effect is minimal. Over long periods, it can become measurable. Vanguard is built around a single assumption, the end investor being a long term owner. Idle cash is minimized aggressively. Dividends are reinvested as efficiently as possible. Portfolio transitions during index changes are optimized for holding periods measured in decades. IVV is built under a different set of constraints. It must remain highly flexible. It must absorb constant inflows and outflows. It must trade smoothly during volatility spikes. That flexibility slightly increases tracking variance because it's designed to be used, not just held. IVV is heavily used in institutional execution and liquidity management workflows. It's used where capital needs to move repeatedly, quickly, and at scale. IVV is embedded in prime brokerage balance sheets, ETF creation and redemption arbitrage, and overlay strategies that require instant equity exposure. More institutional use creates more volume. More volume tightens spreads. Tighter spreads attract even more institutional use. This pattern contributes to consistently higher secondary market liquidity. If you're deploying large blocks of capital, executing reallocations, or trading intraday around volatility. Liquidity isn't a convenience, it's risk control. If you're dollar cost averaging monthly, contributing through payroll, or holding for decades, this advantage is largely irrelevant. Liquidity becomes materially important during periods of market stress, and its relevance becomes apparent during stressed market conditions. IVV is frequently used as a substitute for the S&P 500 futures traded on the CME. Futures come with constraints. They expire, they introduce basis risk, and they require margin management. IVV avoids all of this. IVV allows desks to maintain equity exposure without contract expiration, without rolling costs, and without futures basis risk. For many institutions, IVV becomes a short term exposure holding instrument, a way to hold exposure cleanly while capital is being redeployed. The ETF structure allows funds to meet redemptions by delivering securities directly to authorized participants instead of selling them for cash. When other investors sell, the fund doesn't need to realize capital gains, and realized gains inside the fund are what create taxable distributions. In mutual funds, other investors' activity can generate your tax bill. In ETFs, it generally doesn't. Both VOO and IVV benefit equally from this design. Both distribute minimal capital gains, both are structurally optimized for tax efficiency, both allow long term holders to defer taxation until they choose to sell. Markets are driven as much by behavior as by fundamentals. VOO is predominantly held by long term investors. These investors contribute steadily, they rebalance infrequently, and when markets fall, they're likely to add more capital. IVV attracts capital managers, institutions, desks, and strategies that treat exposure as temporary. Positions are entered, adjusted, reduced, and replaced. A long term investor using a traded oriented instrument will overreact to noise. A tactical manager using an ownership oriented vehicle will feel constrained. These are not analytical errors, these are psychological mismatches. The fund you choose should match how you actually behave during drawdowns and volatility. Once you accept that VOO and IVV deliver the same market exposure, the decision stops being about optimization. It becomes about alignment. Professionals search for the right tool for the job. If this is a retirement account where capital enters steadily and exits decades later, VOO aligns with that. If this is passive wealth accumulation where simplicity, consistency, and low friction matter more than flexibility, VOO also aligns with that. If you're deploying large allocations, rebalancing portfolios, or executing capital movements under time pressure, IVV aligns with that. If you use tactical overlays, hedging, or temporary exposure around macro events, IVV also aligns with that. Alignment determines everything. Choose the ETF that matches how the capital will be used, not the one that looks marginally better on paper. There's no universally superior ETF. Suitability depends on use case. VOO is designed for long-term ownership with minimal ongoing intervention. IVV is designed for active use within larger institutional portfolios and systems. If you understand that distinction, you stop comparing products. You start matching tools to intent.